All right, stock market analysis and projections. We always want to share this slide with you, which essentially tells you about our approach to analysis and about you using our analysis and the important aspect of trade ownership, which, by the way, we have a video on that in our video library. So I think you'll find that very interesting. You always must own your own trades. All right, for this week, well, we had an index rebound, which it gave up the gains. Markets are now fractionally lower for the week, and before you know it, it might actually be 1% down for the week because as I speak, the markets are falling. So this reading was just a little while ago, and the markets are moving so much that probably will end up differently than where it is right now. Tariffs are in focus as analysts believe they're inflationary, and everybody is nervous about higher prices, and I believe that actually higher prices slow the amount of buying, and that ultimately tariffs are going to end up to be deflationary. Add to that, cutting the size of government, which we see is going on, and cutting that spending is deflationary. Look at Lulu, down 13% on earnings, and they came out with a warning that consumers are pulling back. So certainly the consumers are overspent and afraid of what's going on right now. So Lulu warns that consumers are pulling back and consumer type stocks are getting hit pretty hard. The PCE came out, which is the Fed's favorite inflation reading, and that was just a little bit hotter by a tenth, but bonds didn't care because now bonds are ticking up on Friday here because of concerns about the economy. And as stocks get sold, money is moving into the bond market. Now, the bond market has been weak, and I'm going to show you an interest rate chart in a couple minutes that really speaks to the fact that I think that interest rates are going to fall and that is going to be a result of money moving in to bonds as the stock market falls. So I think that we're just getting into what will be a favorable period for treasuries and a period where interest rates fall. Now, don't hear me saying that the Fed is going to cut rates in any significant way because we've seen bond markets move with interest rates moving a point without the Fed or opposite to what the Fed is doing. So I think the Fed maybe only have, one or two cuts this year, but I think that the bond market will be more volatile than that. Short-term analysis suggests that there will be further upside attempts ahead and then trouble. However, the market right now is getting to some levels where it may warn those upside attempts will be feeble. And I'm going to show that to you as we move into the stock market analysis. Before I get there, just a reminder, our level 3 special, we're in our final 3 days, you get 35% off on that. And if you're watching a clip right now of this analysis on the stock market, Matt has in the full show a much broader explanation of what's in this special, so you'll want to watch that. Or go to the top of the website where it says special offer, 35% off, and you can get the information right there. All right, stock market. We're going to look at the VIX, the S&P 500, the NASDAQ, and the TNX, which is the 10-year yields, multiple time frame analysis. Short-term rising phase established, and the resistance is proven. As you see, it got right to it and then turned right back to the downside after that. The VIX helps us with timing, and there is a warning from 10-year yields. Intermediate risks are high. And as I put posts out on this show coming up, I made sure that I mentioned there is a bearish warning. We've been warning about that. And now as the market gives up most of this rally that we're looking at, then it says to me, there is trouble out there. So let's take a look at as we switch over. Now I want to look at the VIX first. And so here's the VIX weekly, daily is what we're going to be concentrating on here. Let me just expand this for you to see on the weekly. So you can see the weekly cyclical patterns in here, which are very nice. It's a very consistent rhythm in there. And of course, when you get towards the end of a cyclical pattern and the VIX is falling, that's usually where the stock market is rallying. And over here is where the stock market starts making peaks. And then, of course, where you get upside spikes is where you have declines in the stock market. You had one of these right over here. And note, as we're getting down back to the lows, well, the VIX isn't really getting up very high in here. I actually think that the big risk for the stock market is in May, June. Now, it could get worse. It could be earlier based on what we're seeing here in the S&P 500, is it that and the NASDAQ are getting down to some key levels. So right now, the projection is such that probably the VIX has another pullback, the market has another rally into late April, so about a month from now. And then when you get over here, May, June is where there is a lot of risk on the downside. When I show you the analysis on the yields, on the 10-year yields, you're going to see how this coincides, because if the 10-year yields are going to fall sharply, that would coincide with money moving into treasuries as the stock market falls sharply. So that's why I'm looking at this correlation, this period right in here, where your April, May, June, where it's very likely that you will get a pop up in implied volatilities. They could get up to, back to this level, which was around 30, but they could go to 40 or 50 during that period, as that would be the levels where there's a panic into buying puts for insurance. So right now you can see we're in an area where the stock market could bounce, implied volatilities could pull back again for some period of time. I'm just going to call it maybe 3 or 4 weeks. When I look at the daily chart in here, and I'm just going to blow this one out for you right there, you can see the cyclical rhythms that are in there. Now, those of you that are new to cycle analysis, what these brackets are on the bottom is a drawing tool, and it just simply helps us see the flows, the movements, or the heartbeat of the market. And money flows is the way we really look at it. And when VIX is coming down, money is flowing into the market. There's not a lot of pain going on. And as the stock market had a rally back in here, then VIX was falling. But now you can see it's rallying again right there. When I project out over here and look at this cycle, that points to around May 1st. So I just said end of April potentially for the time period where the stock market could hold up till. So that means that the stock market's going to have to, get to where it's not selling off like it is right now. With right now the S&P's down 100 points intraday here, a midday on Friday. Note the this orange dots in here. When you get those orange dots, it is a warning of an extreme overbought or oversold condition. In this case, the VIX was extreme overbought, and that means an index bottom was pending right over there, and that's actually what happened. So right now we're getting a neutral reading. I don't really have anything to give you. See, the same thing happened over here. Those of you that want to learn about our OBI option bias indicator, write to Matt at askSlim.com. He'll tell you how to get information on that. It is a great indicator. Here you could see this is still red, which is suggestive that this move up in the VIX is going to stop, and that the panic that's going on right now will probably end. But I think this analysis is important. The VIX really helps us time things, and right now it's saying to us that, well, April could be okay. In other words, you could get to where you stabilize here, and then April kind of holds on until it doesn't. And then that late April through early June period is very risky looking at that. So now let's switch over, and I'm just going to go back to where I could see the MCM, and we're just going to put up SPX here, and I'm going to move off of gold on here, and then we have the our indexes there on the MCM. Remember, the MCM is a level 3 and 4 application that's fantastic. And this is one that you would get with the level 3 promo that we're offering and ending this weekend. So here is the S&P 500. Let's just blow this up. DJV sent me an email that some of the stuff is missing off of the charts that we share, a couple of the indicators. So I'm going to fix those if you did, DJV, if you didn't see the message I sent. So here's the cyclical patterns in here, and you can see this is where the two cycles meet, and that's where the declining phases. So in other words, money flows in, money flows out. The longer, more dominant it is, the longer the holder, essentially, when you look at that. If I'm looking at monthly, I'm looking at investors, basically. When I'm looking at weekly, well, then I'm looking at kind of intermediate holders in here, and then so the minor cycles are probably more in the short-term category. And when they're both liquidating together, you get the declines, like you saw right over here, the minor one right over here. But look at this low right there that was broken. That says that it's very likely that a decline is going to come out into this May-June period. That's what I just showed you out on the VIX. And when I show you the interest rate pattern, you're going to see there's a correlation that's very important. And so we're still looking for a failure in here, but based on what I just showed you in the VIX, it could hold up here and then just keep bouncing around in here for a few weeks before really taking hold and getting sold. The most bullish case I can make is a test of 54.85. That isn't very far down, a couple percent from here. But that's a bullish case. Really looking for a move under to 5,400 or potentially down into this area in the 5,200s, or at an extreme at about 5,100, which is a monthly fib extension, 38.2. So that's what the targeting is. This is pretty extreme. It would mean the market's going to be in a pretty good free fall, and that would be about a 17% decline off the high, which is just a little bit more than a normal correction. So that's certainly not yet a bear market if it gets down there, though a lot of the tech stocks are already well into bear market territory. You want information, of course, go to askSlim.com to the top to the workshop tab, and you'll learn about our cycle analysis workshop that you can get. So here is that's the look at the intermediate right there. Let's just look at the short term on the S&P 500 on the daily. Now it's interesting, I updated the charts this morning, and when I did, I put in these minor supports right over here, and here's the 78.6% there. Let's just get a little closer look here, as you can see, and it got through all of these minor supports right there, and here's your 78.6 at 55.66. That would be a problem area if it gets down through there. Had somebody send a message today, well, tell me where the reevaluation levels are. If it gets under this level right over here, then I think the probability of getting back over this level, which is the high we made last week or the early this week, the probabilities of that will be small. So in other words, gets under here, you probably get some rebounds in here, but it's a lot of trouble. If it gets under 5504, then you'll have a breakdown, and that will be awful. And then you could very well be in a free fall if that's going on. Upside, you would have to get way up over here at above 6,000 to get out of this, to reevaluate or repair this very bearish scenario. And I think based on where we are now, that is not likely. I've seen a lot of analysis out there that is looking at charts that says this, bear flag. They looked at this bear flag here in the daily chart and said, well, we've had tons of bear flags over these last couple of years. Most of them have come with momentum very strong on the weekly chart. In this case, momentum is very weak on the weekly chart. And you can see that in our reversal scout, which is very weak right over there. So the probability of surviving what is a bear flag, well, it already has not survived it, as you can see. So those key levels down over here, as I mentioned, 55.66. If it gets below that, it's not likely we're going to get back up to this rebound level that we've seen so far. Let's look at the NDX also, which looks pretty similar to this, and blow up this weekly chart. And you can see the same thing. I mean, really projections down into the 1800s down here. that monthly 38.2 is just around 17,800, 1,500 points from here. This area right over here, where that 78.6% support is, that looks like a reasonable target into these areas near 18,000 on the downside, and that would again take you out into this May-June period. This is worse because when I look at the daily chart here, you can see it's already broken that 78.6%. So these supports all have to come out because they're now meaningless. Those were minor supports, which were based off of this low and this peak. And now what we're looking at is this minor third and this minor half cycle. And this takes you out to early or to mid-April. This takes you out to mid-April there. See, this is the concern. If you don't hold this at 19,152 support, then you're already going to be in the downside resumption. Right now, it needs to hold. It needs to pull up in here and get away from this problem area. But the fact that it's gotten down to that level is bad, and likely means that this intermediate momentum that you see right over here on our reversal scout is so powerful that it already aborted this upside move. And again, as you see here, this resistance level is now proven, just as it was in the S&P 500. Let's go back there for you to see that it has essentially proven this resistance area right there and now moving down. So this is really extremely negative when you look at that. You know, it's had the opportunity to rally, it couldn't. Now it really needs to make a stand where it is, or there could be a lot of trouble in the stock market. Let's take a look here at the, I'll look a little bit more at the conditions in here in some of the stocks in a moment. But you can see here on the indexes on the short term, you're looking at bearish to slightly bearish, though the Dow is neutral. So in other words, they're moving into some of the safer stocks as the market moves down. That's kind of a change in allocation that we're seeing right there. And the IWM is the most bearish, as you can see. Let's just look at the intermediate term here, and you can see that the IWM is neutral, is bearish. The rest of them are in neutral category for the intermediate. So that upside bounce gave them a little bit of an improvement. You can see these upticks right over there that occurred. That gave you a little bit of a bullish change there on the intermediate that brought them to neutral. So there's nothing to be excited about there. The short term is still a little bit bearish, and there is hope for them to begin to move to the upside. Before I look at some stocks there, I want to go back to the conversation that I had about the TNX, the 10-year notes, because this is, to me, very important. There's a lot of times when 10-year notes fall, rally and the yields fall because there's a flight to safety, money moving in when there is a good sized decline in the stock market. Look at the cyclical rhythms and the harmonic families on the bottom. This is just absolutely incredible because the rhythms are just spot on. I mean, talk about having a guide to trading a specific sector. This is an amazing guide when you look at interest rates, which are inversely correlated to the bond market. So where are we now? Well, if you look right over here, I want you to look at this cycle. See the intermediate cycle right there. You can see where it bottomed here and then rallied for a couple weeks, and then the momentum turned negative. And then because it broke this low right over here, it's set up for a decline all the way through the next time when there was the nesting of all the cycles of the different periods of holders, as you can see, which essentially was money moving into the 10-year bond, the 10-year notes. That's what this represents. Then when you moved up here, money moving out of the 10-year notes as yields was rallying. Look what happened here. This is identical to this, where you had the rally, the break below the cycle low, and that points to a decline here in yields out into May, June. That's exactly the inverse of what I'm telling you in the stock market. So yields are likely to fall, or that's positively correlated uh, with the stock market falling or the bond market moving up. This is a sign right over here to me that two things. Number one, the bond market is likely a buy because it's had a pullback and now getting ready, I think, to move up. And if the stock market holds for a couple weeks, well, maybe this doesn't move that much right now. But then here, this is a big move down into yields where they get down to 4.6 to about 3.9 right there. And that's money flowing into the bond market as these yields fall. And to me, that correlation is a big warning about the stock market, and that period in May, June could bring a sizable decline that would push these yields down. So I thought that was very important analysis to this discussion, going back to the S&P 500 and how that decline in yields or rally in bonds exactly lines up with the stock market, which is to me astoundingly important information. Bond yields to fall, bonds to rally, because money moves out of the stock market and into the bond market. You've got to be very cautious. If the low gets broken here on these daily charts, we could be into a free fall time period, and you don't want to be buying that falling knife, as they say in the cliche. So possibility for some rally if it holds up here for just a few weeks, but a lot of risk there. Let's just take a look here at the individual stocks as we look at the conditions in here. Let's start out with the ones that are very bullish. Now, we've added a bunch of symbols in here, as Matt mentioned. So we have our algorithms built into this, and it just tells you which ones are bullish, very bullish. You can get notified on the changes in there just by choosing the notifications and clicking the ones that you are interested in getting, and you'll be notified in that. So the ones that are very bearish show up right there, and very bullish right here. Let's just get rid of that notification, and let's scroll here, and you can see what we have here. We have gold stocks and silver stocks and those ETFs as very bullish and remaining so. There's silver stocks. Interestingly, McDonald's is very bullish as money has flowed into there, I think, as a safety bid. Now, today it's getting slammed as the consumer stocks start to get hit, and there could be a warning that that is beginning to change on McDonald's. Chinese stocks, Baidu, there's silver, Newmont, the junior miners right there. You can see all the ones that are bullish and all the ones that have kept you on the long side looking at that. And all these are very bullish. Telephone, very bullish because that's, of course, a flight to safety type stock because you can get dividend yield on that. And just a number of these in this category. Cigna, which is an insurance stock, very bullish as you look at that. So this is all a lot of great information. There's some more gold stocks showing up right there. Now let's take a look at the ones that are very bearish. Now we're looking at short-term conditions right in here, and you can dial those in to near-term, intermediate, depending on what type of a trader you are. Intraday only level 4 has access to the intraday ones that are there. And let's take a look at the ones here that are very bearish. As you could see, and a lot of stocks in here that have gotten hit. Nucor may be based on the tariffs getting in there on the steel stocks. Nike, a consumer stock, of course, and that's had problems. Walmart was being bought like crazy, and then it turned around to the downside. And you can see all of these stocks that are very bearish. Wheat, very bearish. You could see that. The healthcare stocks, very bearish. IBB, very bearish. LVS, microchip, of course, and a lot of the chip stocks are looking very bad. And a big list in here, as you see, of stocks that are very bearish as I keep moving down. Now we're in the bearish category. So wanted to show you this. This is a great way for you to get a real handle on the conditions. And if you're a short-term trader, let's say a swing trader, then you'll be looking at near term, and you can dial into those also and get a good sense for that. So that is a look at the MCM. That's a look at the S&P 500. I hope that the discussion of that correlation to the VIX and the correlation that I showed you to the 10-year yields resonates with you, that it makes sense, because it's going to be that's information that's going to be important to us moving forward. If this market continues to move to the downside, then you'll start to see the bond market really start to get bid, yields start to fall, as I think money begins to move into a place of safety.